Hello everyone and welcome back to another video. In today's video, I want to talk about the 3 things that I value most when I'm looking into a new stock or a new investment right now. These 3 things I believe have increased my skill as an investor, and I really hope that they can help provide you with some more insights when you're doing your own stock analysis as well. As always though, I am not a financial advisor and this is all just my own opinion. This is not a recommendation or anything like that. It's just what I personally look at and my own opinion on stocks and whatever. So that's my disclaimer. I'm not a financial advisor. And with that being said, let's hop into the video. All right, so the first main thing that I look at right now is the management of the business that I am looking at investing in. And this kind of covers a wide range of different things. So I'm going to break down the management in a few different sectors and actually use a stock that I own as an example for this section. So the first thing that I'd like to take a look at in regards to management is how much shares of the business do the management actually own? Like what percentage of the company do the insiders actually own? How invested in this business are they and how much skin do they have in the game? The reason for this is because if the insiders are heavily invested in the company, then it gets them thinking more like a shareholder and not like someone who is just receiving a paycheck from the company. If they have a large stake in the company, then it most likely means that they want the shares to go on and do well in the future. Also, when insiders are heavily invested, it most likely means that they're not going to just do stock dilution for no good reason. And they're probably going to really consider doing additional stock dilution because when they do dilution, they're going to be diluting their own positions as well. For example, Trulieve insiders own 28.3% of the outstanding shares, which is a massive amount. This gives me additional confidence that the management is going to take care of their shareholders and focus on creating shareholder value because they are massive shareholders themselves. They directly benefit from the stock going up, just like I do, so their incentives are directly in line with protecting my investment. The next key thing that I look for with management is, are they buying or selling more shares in the business? Insiders selling shares of the business is something I take note of, but I don't put too much weight on it. Like if the insider is selling all of their shares as quickly as they possibly can, then yeah, it's probably not a good thing. But if they're selling some shares here and some shares there, then I really don't care. What I like to place value on is, are they buying more shares? Because there can be any number of reasons for an insider to sell shares in a company. They may want to buy a new house, they may want to buy a new car, they may want to go on vacation, literally anything. However, there is only one reason why insiders would buy more shares, and it's because they think the stock is going to continue going up. So I really like to see insiders buying shares in the company because it clearly means that they're optimistic on the business they're working for. Trulieve again has had insiders buying more shares of the business, and they're buying pretty consistently too. Recently, the CEO, Kim Rivers, actually purchased more than $1 million worth of shares. This once again gives me more confidence in the management and in the company. The next thing I look out for in regards to management is how much stock-based compensation is going on versus the company's profits and growth. High stock-based compensation is a red flag for me. It's not the end of the world, but it requires me to do additional digging on the business. So let me show you another example here. This here is a company's cash flow statement, and on it, we can see that the business has done hundreds of millions of dollars worth of stock-based compensation over the past 3 years. In total, this is about $700 million worth of stock-based compensation. So okay, when I see this, I think this business must be absolutely killing it. Like the management is rewarding themselves so much, so the company must be doing great, right? Well, not at all. Here we can see that this same company has lost a total of about $3.3 billion over that same time frame. If we also take a look at this business's income statement, we can see that over the past 3 years, they have done about $1.1 billion in total revenue. So about 63% of the revenue is going to compensating the management while the business is losing billions of dollars. Now, stock-based compensation doesn't quite work like that because the compensation is paid out in shares of the business and not from the actual cash that the business has or is generating. But it's just how I like to take a look at it. So to me, this doesn't look like a company that is very focused on creating shareholder value at all. And I went and took a look at this business's insider ownership as well, and it's sitting at 0.4% right now. So the insiders own less than 1% of the company. And after what we just saw in the cash flow statement, this does not surprise me at all. Now, on the other hand, if we go and take a look at a business like Trulieve, we can see that their stock-based compensation was only $2.7 million in 2020. And that's it. They did no stock-based compensation in 2019 or in 2018. If we also go and take a look at Trulieve's revenue growth, we can see that they produced about $877 million from 2018 to 2020. So their stock-based compensation was about 0.3% of the company's total revenue over the past 3 years. And again, Truliev's insider ownership is very high. So to me, it looks like Truliev's insiders are focusing on growing the business and benefiting from these shares going up, rather than paying themselves massively in stock-based compensation. I just think there is a very clear difference between these two examples. So to summarize this first section, there are 3 key things I look for with the management of a business, and they are insider ownership. How much of the business do insiders actually own? Insider buying and selling. Are insiders buying shares or are they selling shares as quickly as they possibly can? And then the third is stock-based compensation. How much is going on versus the performance of the company? All of these 3 things are just meant to get me asking, is the management of this business actually caring for the shareholders of the company, or are they in it just for themselves? And I believe that these 3 key points right here really help me determine if the management is for shareholders or for themselves. All right, but now let's move on to the next key thing that I like to pay attention to, and this is the free cash flow of the business, and how much is the business actually producing. Free cash flow is quite literally how much cash the business is bringing in, and I really like to pay attention to this number because it tells me if the company is making money or if it is losing money. I love to see businesses that are producing positive free cash flow, and having their free cash flow growing as well. This is because if the business is producing positive free cash flow, then they can use that money to either grow the business more organically, pay dividends, or repurchase shares of the business. Free cash flow basically gives the business the option to continue growth or reward shareholders, and all of these things are good. Now, if a company has negative free cash flow, then it means the business is losing money and most likely will need outside funding from either the public markets through dilution or through taking on additional debt. I mean, think about it. If a business is losing money, then how is it going to stay in business long term? How are they going to generate cash for shareholders? Well, chances are they're not. And chances are the shareholders are the ones generating the company's cash. Let me show you an example on another business's cash flow statement. Here we can see that the cash from operations for this business has been negative over the past 3 years, as well as the cash from investing activities. The free cash flow has also been very negative, so this business is losing money. This leads me to the question, where is the money coming from? Well, the money is coming from common stock issued, which is the business raising money through dilution, or issuing more shares of the business. We can see that in the trailing 12 months, this company has done $713 million worth of dilution. In 2020, they did $575 million, 2019 was $59 million, and 2018 was $215 million. The revenue for the business has also been declining in recent quarters, and they're producing a loss from operations, so it looks like the business doesn't have any profitability coming in anytime soon. I would actually speculate that this business will continue running off dilution because there is no cash being generated organically, and it doesn't look like there will be anytime soon. Right now, this company is burning cash with no end in sight. This means they will continue relying on share dilution to keep the lights on. So for me, this does not look like an attractive investment at all. Benjamin Graham, who wrote The Intelligent Investor and was Warren Buffett's mentor, calls these businesses OPM companies, which stands for other people's money. Since these businesses do not produce any cash of their own, they will continue relying on other people's money, which I don't like as an investor. So now let's go and take a look at Google, which is an absolute cash flow machine. And by the way, if you want to learn how to read cash flow statements, balance sheets, and income statements, then I have a full playlist on my channel that covers how to read all of these 3 statements for beginners. But now let's get back to Google. Here we can see that their cash flows have been growing very consistently over the years, and they are continuing to grow. This is ultimately allowing Google to buy back shares of their own business, which is quite literally the opposite of doing dilution. Google doesn't pay a dividend, and they reward their shareholder through share buybacks. We can also see that these share buybacks have increased with Google's free cash flow. So over time, as Google continues producing more and more cash, they will continue rewarding shareholders by buying back more and more shares. This right here is a business that does not rely on any outside money, which is why we can see here that they haven't issued any common stock for the past few years. They simply don't need to, because this business is organically generating billions of dollars a year. So for me, I like to see businesses producing positive cash flow. But I can already hear some of you saying, Daniel, Trulieve has a negative free cash flow, so why do I like this stock? Well, Trulieve is a growing business, and they're investing all of their cash right back into further growth for the company. Here on their cash flow statement, we can actually see that the business is producing positive cash from operations, but they are reinvesting all of it and more back into investments in property, plant, and equipment. This is what is fueling all of the growth that the business is currently seeing. And this is what growing businesses do. They don't focus on generating or growing tons of free cash flow right away, but rather they like to invest all of the cash from operations back into capturing even more growth. And this actually leads me incredibly well into the third key thing that I like to pay attention to when I'm looking at a new investment, which is growth versus value. And let me explain. Warren Buffett says there is no one calculation that will tell you if a business is a good or a bad investment, and I agree. I think many people out there want investing to be easy, where it's like any stock in the market that's selling for a price to earnings ratio under 20 is immediately a buy, and any stock selling above a 20 price to earnings ratio is way too expensive, just ignore it. Or in TrueLeaf's case, this is a business producing negative free cash flow right now, so this has to be a bad investment, right? Well, in my opinion, this is just not how investing works, and there are way too many variables to consider with every single business. Warren Buffett also says that the question he asks himself is how much money can this business produce in the future versus its price today. So let's take a look at Berkshire's Amazon investment, and I'll show you exactly what I mean. I do also have a full video breaking down why Warren Buffett thought that Amazon was a value investment back in 2019. So if you want to watch a full video, then there's that too. But let me just quickly summarize this in this video. Alright, so the earliest evidence that I could find Berkshire buying Amazon shares was on May 2nd of 2019, where this article says, Berkshire has been buying shares of Amazon. Warren Buffett says. I mean, it doesn't get any more clear than that, right? Now, back in May of 2019, Amazon was trading for a price to free cash flow of 46 and a price to earnings of 80. So how could Amazon possibly be a value investment when the price ratios were so high? Well, remember, Warren asks himself, how much money can this business produce in the future versus its price today? Warren doesn't solely focus on what the business is producing right now, but rather what its long-term potential is and how much he is paying for that future potential today. And let me show you what I mean. Here we can see that analysts are expecting Amazon to produce $74.9 billion in free cash flow and $52 billion in earnings by the end of 2023. Now, in May of 2019, when Berkshire purchased Amazon shares, Amazon was trading at a $946 billion valuation, which means that if Amazon can hit these 2023 projections, then Berkshire's price to earnings on cost is 18.5, and their price to free cash flow on cost is only 12.9. So if these 2023 projections come to light, then the price Berkshire paid in 2019 will look like an absolute steal. And if Amazon can continue its growth, then just imagine where this company could be in 10 years and how much of a value investment it will have looked like back in 2019. So yes, Amazon looked expensive at face value in 2019 with those incredibly high multiples, but given how fast this business is growing and its runway for more continued growth, a long-term investor like Warren Buffett could have seen that the value was there even at those higher multiples. This is also why I strongly believe and preach here on my channel that growth and value investing are not mutually exclusive and that they are actually the same thing. Countless times in the past, Warren Buffett has confirmed my belief. I personally think that investors get way too carried away with focusing on one financial ratio and not focusing on the simplicity of investing in wonderful businesses for the long term. I do my absolute best to look at every single business with a clean slate, and I try to focus on understanding the business, its potential, where it could be in the future, and how confident am I. The only question I am trying to answer is how much cash can this business produce in the future versus its price today? And the hardest part about answering this question comes from me as the individual, not developing a bias towards the company. By the way, Berkshire has nearly doubled their initial $1 billion investment in Amazon in just 2 years. And I would love to get Amazon at a price of $1,900 today. I mean, how much of a value investment would Amazon be at $1,900 today? Berkshire absolutely nailed this one. Now, let's circle back to TrueLeaf. Yes, the business is producing negative cash flows right now, but as we learned, this is because the business is investing everything back into growth. However, I believe that long term, once the business's investments back into growth slow down, then the company will be producing over $1 billion, if not multiple billions, in cash flow annually. When this eventually does happen, I speculate the business will start paying dividends or buying back shares of the business to reward shareholders that way. The business has a valuation of about $5 billion today. So if I believe that they can do $1 billion or more in cash flow in the long term, then this valuation looks incredibly attractive to me personally for a long-term growth investment. Again, this is just my own opinion though, and it's me doing my best to answer Warren Buffett's question. how much cash can this business produce in the future versus its price today. But to summarize this final section, I really do my best to pay attention to the growth of a business versus its value today when I am looking at investing in any new company. Now, to summarize the whole video, the three main things I look for when I am investing in businesses are the management, the cash flows, and the long-term growth versus the price today. Alright, and that's pretty much going to wrap up the video, everyone. But what do you all think? Do you guys agree with these three metrics, or do you focus on different metrics? Actually, if you focus on different metrics, let me know in the comment section below what metrics you would rather focus on instead of these three, because I'm always looking to learn. Also, if you enjoyed this video or you found it helpful in some way, then please remember to leave a like on it. It really helps out the channel, and I really appreciate it. If by chance you're new here and you want to stick around and see more stock market related content, then please consider subscribing to my channel as well. And with all that being said, I really hope to see you all again in my next video.